Good morning and welcome to Charting the Markets on Friday, the 15th of September. US equity markets rallied overnight, and so did the Asian session earlier this morning, as investors shrugged off a hotter than anticipated producer price inflation reading, but focused on the successful IPO of Arm Holdings, with its share price rising by nearly 25% on the day. And earlier this morning, we also had the People's Bank of China, which cut its reserve requirements for the second time this year, all of which led to risk-on sentiment and equity markets rising in general. And you can see also that we had a very positive session yesterday in the United Kingdom. When we look at the daily financial bet of the FTSE 100, we can see that the FTSE has risen by 2%. And basically did so on strong, on higher oil prices and also other commodities, pushing several of its constituents higher as commodity prices rise, leading to one of the strongest performances for the FTSE 100 this year. And as you can see here, that was followed through earlier this morning, with the FTSE 100 reaching 7,747 on this daily financial bet, taking us to levels seen back at the end of May of this year. Now, from a technical perspective, if we can see further follow through to the upside next week, because this week after yesterday's strong rally, we are very likely to see another positive week for the FTSE 100. As you can see here on the weekly chart, we now have basically 4 consecutive weeks of positive readings, and we are in the process of rising above the July highs. Now, if we can close above there on the weekly chart closing basis today at 7,723, then for me, technically, that would mean that the lows we've tested, the lows going back to March of this year, have now held 3 times in a row, and that we are actually forming a bullish reversal pattern, which would take us all the way back up again towards the February highs at around 8,000. So that will be very, very interesting to see. But even if we don't manage to rise above the July and August highs just now this week, maybe we could do so next week. And then technically speaking, the same scenario is really in play, in that we are taking out the last reaction high here. We formed what is called a double bottom, and the upside target of that would then be above the 8,000 mark. So possibly we could see a reversal in the fortunes of the FTSE 100 over the next few weeks. And this is actually quite interesting, because usually September is, historically speaking, quite a negative month. And here what we're seeing at the moment, at least for the FTSE 100, is actually quite a positive month occurring so far. And the fact that we've now also risen back above the 200-day simply moving average here in red at 7,640 is also encouraging. And to me, it looks as if further upside is in store for the next few days and weeks. And basically, this will remain the case from a technical perspective, provided we stay above this low we saw last week at 7,369. The European markets with the DAX are not quite as bullish as the FTSE 100, because as you can see here, we've been trading in a sideways trading range since May of this year. And we, again, though, have held above the 200-day simply moving average here in red at 15,544. And also this week's low was made above the low seen back in August at 15,469. All of which is positive. And also added to that, the fact that we broke through the July to September downtrend line and have now risen above the 55-day simple moving average here in orange at 15,912 is telling us that the momentum has shifted to the upside, and that we are heading back up again towards the late August high at 16,044. Now, this is the key resistance area, because if we manage to break above that and close above that level at least one day on the daily chart closing basis, then for me, technically speaking, what we're seeing here also is basically a double bottom formation, and that could then take us back up again towards the 16,500 area that we saw back in July of this year. So further upside likely to be in store for the DAX 40 contract, provided we stay above this week's low at 15,561 on a daily chart closing basis. And this bullish sentiment I've seen in the European sessions here is also replicated in the US. And as I said, US markets yesterday shrugged off the hotter than anticipated producer price inflation data, and rallied also quite strongly here, and are now on track to reach the September high at 4,540. And if that were to be taken out, the next upside target would be represented by the July high at 4,607. So from a technical perspective, we're seeing further upside here also with regards to the S&P 500. And basically for me, provided we stay above the 4,430 low that we made earlier this month, further upside is in store for the S&P 500 as well. The European Central Bank yesterday hiked its rates for a 10th consecutive time to 4% for its deposit facility, and at the same time said that it didn't expect to raise rates any higher in the foreseeable future. And that has obviously had a detrimental effect down to not just the 106.36 May low here, but actually dipped down to 106.32. And that was a level last traded back in March of this year, as we can see here. So short term, we seem to be holding at this support area because after all, we're heading or trading around the May low at 106.36. So we may see some short term support on this chart come in, but from a technical perspective, from a medium term perspective at least, we clearly remain within this downtrend channel. And unless we take out the last reaction high at 107.69, which was made on Tuesday of this week, the trend is your friend, and that's clearly still pointing down. And even if we were to take out that high, we would also have to rise above the 200-day simply moving average at 108.30 before we could start to perhaps invalidate that downtrend momentum that we've seen over the last few months. So euro dollar does remain still bearish. The European Central Bank yesterday also mentioned that its growth forecast into 2025 had been revised lower. And it also said that inflation in 2024 in the Eurozone would remain above the 3% mark, all of which is not pointing towards positive growth in the Eurozone. And therefore, it's not surprising that the euro is actually continuing to fall here against the US dollar. And the US dollar remains the flight to quality currency that everybody heads towards when people want to have a safe haven asset they can invest in. And you can see that also on the US dollar versus the Japanese yen. We had a small blip lower on more positive data after Japan earlier in the week, but since then we've just risen back up again towards this 147 yen and 87 sen high we saw earlier this month. And it looks to me that this will be exceeded in the next few days, in which case we could be heading back up again towards the psychological 150 yen mark. And now that is an area where the Bank of Japan is likely to intervene. But until we get to that high around the 150 mark, further upside looks to be more probable than any short-term reversal to the downside. Now, if a reversal were to indeed happen, and I'm not saying that it will, I actually expect further upside to be seen for the US dollar. We can see here that we would have to fall through the last reaction low, that is at 145.91, for us to at least form a minor top. So unless that happens, further upside is actually in store for dollar yen as well. And if you look at China, here we had some positive data out of China earlier today. That, plus the fact that the People's Bank of China once again cuts its reserve requirements for the second time this year, has led to some short-term strength in the Chinese yuan, and it stopped the decline we saw in this currency pair short term here. So we saw some strength on the one here, but right now we're bouncing back basically with regards to the US dollar short term. And US dollar strength seems to be on track, and I'll show you that in a minute, for its 9th consecutive week of gains in the US dollar basket. But here against the Chinese yuan, we can see that we're trying to head back up again with regards to the US dollar, but we're struggling to do so. as more positive data out of China recently led to the Chinese yuan appreciating versus the US dollar. But from a technical perspective, provided we stay above the orange line, the 55-day simply moving average, and more importantly, the current September low at 7.1 and 23.92, then further upside is still in store because we still have a series of higher highs and higher lows, which is a definition of an uptrend. And only if we were to fall through 723.92 on a daily chart closing basis, could we say that we would have at least a minor top in place, in which case we could perhaps see a slide back towards the 712 area or so on this currency pair. But right now, the US dollar is trying to push high again, once again. And as I just said, the US dollar basket, as we can see, he has been trading in a very clearly defined upward channel, has done so since mid-July. And we are now on track for the 9th consecutive week of gains in the US dollar basket, as you can see here. And what is interesting from a technical perspective is that we're getting closer to the March high, and that was made at 105.51. Now, if we were to manage to rise above that March high and also the high seen back in January of this year at 105.38, then it would mean, from a technical perspective, that we have actually formed a bottoming formation and that much further upside in the US dollar is in store, which could then take the dollar basket all the way back up again towards the 110 area. But this is a big if, because we've got this high from January, we've got the high from March, and it could actually spell the end of this 9-week consecutive winning streak for the US dollar, as the US dollar might actually struggle in that resistance area as it capped it in the past. So next week is going to be quite interesting with regards to US dollar strength. Can we continue or not? Obviously, we have the FOMC meeting on Wednesday and Thursday, and we will see whether the US Fed will once again hike its rates, or actually, as most market participants seem to anticipate, maybe keep its rate at its current levels. We also on Thursday have the Bank of England, of course, and probably also on Friday, the Bank of Japan. So a lot of central banks announcing their rate decisions next week as well. And that will obviously have an impact on the US dollar. The stronger US dollar has had a detrimental effect on quite a lot of commodities over the last few weeks. And we can see the impact of that on the gold price. And as you can see here, the price of gold, as that US dollar strengthened, has slid from its early September high at $1,953 per troy ounce to yesterday's low at $1,901 per troy ounce. And this is an area that we mentioned over the last few weeks that we thought the gold price would come back to a psychological support area at 1,900. But now that we've hit that, it's not surprising that we're actually trying to bounce back. We are trying to leave this downward channel we've been in since the beginning of the month and hit the red line here, the 200-day simple moving average at $1,923. Now, if we were to manage to rise above that, and also above Monday's high and the orange line here, the 55-day simple moving average at $1,931, then we could actually resume the uptrend we have been in since August. And that would mean that we would perhaps break through this downtrend channel, that downtrend resistance line that goes back to the July highs, and head back up again above that line and head back towards the $1,950 mark. But that is actually anticipating a lot short term. We need to have more building blocks for this small upward momentum to gain traction. As I say, ideally what I would like to the 200-day simple moving average either today on the weekly chart closing basis because it's Friday or next week. And then also we need to take out the $1,931 per troy ounce mark for us to be heading back up again towards the 1,950. Unless that happens, we could just see a sideways continuation phase over the next few days with regards to the gold price here. Now, I'd like to also look at WTI. US crude oil prices have been rising quite steadily over the last few weeks. And if I take a ruler on here, you can see that from the late August highs, lows, we have already risen by nearly 15% with regards to the oil price. And obviously this might in the future have a detrimental effect on our economies as the higher oil price, together with other commodities such as as sugar, I believe, is trading in 12-year highs. Cocoa futures are trading in 44-year highs, all of which might have an impact on the inflation rate and make inflation sticky for a lot of countries. Now, that is a possibility, especially judging the higher oil price here. As you can see, we've now risen with regards to WTI to this psychological, I should say, $90 mark. We've risen to $90.63. And this is a level that we last traded at back in, it was November of 2022. And you can see here the next upside targets potentially for the price of WTI for oil are the October and November highs of last year, between $92.70 and $92.95. So the price of oil does continue to rise on the and also worries about exports from Libya, where we had these awful floods over the last few days, also pushed the oil price higher. And I'd like to finish up on volatility. I know it's not a commodity as such, but we are now trading at levels below those seen back in July of this year at so far just below the psychological 15 mark at 1493 for the VIX, the volatility index. And if I zoom out onto a weekly chart, we can here see very clearly that volatility has dropped to levels last traded back in February of 2020 when the pandemic kicked off and volatility exploded. So that means that basically investors are very complacent. They are not worried about anything. They're not worried about inflation. It could also mean that short-term, perhaps equity markets might actually do what is not usually the case in the months of September and rise and perhaps even have a positive close into the end of the month. But usually what happens is that volatility does pick up between September and October. If you look at last year, this is volatility picking up in that period there. If you look at the volatility spikes we saw back in September here of 2021, and again in November, October, November, again, we saw a spike of volatility. And the picture was quite similar here in September, October of 2020. We saw another spike in volatility. So it wouldn't be surprising if we see another one. But right now, we are trading at, as I say, lows seen back in February of 2020. So that is a 3.5 year lows with regards to the VIX. So at the moment, at least, short-term volatility is pointing to lower levels still. And that might mean that the advance we're seeing in equity indices is a very gradual one, but accompanied by low volatility. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, that's the formerly known Twitter, and my handle is @AxelR_IG. Have a lovely weekend.